So, hey, welcome back to Accelerated Investor. Hey, I'm your host, Josh Cantwell. And today I've got a fantastic discussion with a 25-year tax attorney. He's a founding partner at Andersen Advisors, and he's made a career focused on saving people money and making money with business owners and entrepreneurs. His name is Toby Mathis. And as a result of their work at Andersen Advisors, with tens of thousands of successful investors and clients, they've prepared over 100,000 tax returns. And Toby's pieced together some specific methods for building wealth and for educating people on what it takes to become wealthy and also to legally slash their taxes and then stay wealthy. So in this conversation, the first thing we're going to talk about is number one is the three different types of income: active, portfolio, and passive, and how to not only make more income in each one of those categories, but then also how to slash your taxes in each one of those categories. We're also going to talk about number two, the opportunity to set up a nonprofit and get government subsidized dollars to use in your nonprofit, and then have your nonprofit pay rent to your real estate portfolio. And number three, we're going to talk about three specific traits that Toby feels like everybody needs to have to become an elite entrepreneur. It's a fantastic discussion around tax, around reducing tax, legal, reducing liability, and really talking to an elite investor who owns over 300 different real estate investments himself. His name is Toby Mathis. He's with me today on Accelerated Investor. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
So, hey, Toby, listen, welcome to Accelerated Investor. I've been looking forward to this for a long time. Thanks for carving out a few minutes for us to talk a little bit about tax and legal, different types of income. I'm really excited to share some of this wise, sage wisdom with our group. So thanks for jumping on.
Hey, thanks for having me. It's always fun to talk taxes and asset protection and all the stuff nobody wants to hear about, right? It's the most important stuff.
We'll talk about that. We'll jump into how to kind of set things up from the start, right? To really do it the right way. Because, kind of rewinding in the middle of a deal is hard to do. But Toby, as we kind of introduce you to our audience and they get to know you, why don't you just talk a little bit about some of the passion projects and things that you're working on right now, so we can kind of get a flavor of like, what do you do on a daily basis and what are you excited about? And then we'll talk a little bit about today's market and some of the weird stuff that's happened this past weekend. But let's first talk about you and some of your passion projects. Tell us what you're working on and what you really kind of do on a day-to-day basis for your clients.
Yeah, well, I'm one of the principals over at Andersen Business Advisors. We love growing our firm. There's about 500 of us. I'm an avid real estate investor, the founder of Andersen and myself. I'm a founder as well. Clint Coons, we invest together. We have over 300 properties nationwide, and we're really avid investors. So we teach from experience a little differently than some of the folks that you might run across that don't actually do what you do. But what I really love right now is, like, this is personal view, is that we're about 5 to 7 million units underbuilt in the United States, that we have an affordability issue for housing. It's going to cause mass homelessness and serious issues in our economy for especially folks making under $50,000 a year. And I love trying to find other ways to bring housing that's a little bit lower cost for those people, because there's so many people that are debt burdened and rent burdened, and it's just tons of fun. I know that sometimes we're just looking at the dollars and cents, but when you're doing recovery housing, shared housing, transitional housing for people aging out of everything from foster care, or transitional housing out of creative ways to get people out of jail so that we're not paying $80,000 a year for incarceration. There's some really cool things that you can do as an investor, and I love diving into those niche areas. They're actually really cool.
Yeah, affordable housing. I've looked at a lot of mobile home parks.
Yep.
A lot of cities and counties don't want mobile home parks, but that would seem to be part of the solution. Shared housing, some of these kind of things, because you look at these other places in the world, like Israel, Tel Aviv. You look at Toronto, Canada. The average property is $400,000 to $500,000 for your average. You look at Rome, Italy. If you have a flat in Rome, it's easily almost $500,000 for a small apartment. I've been to Rome. I've been in one of those. They're very small. And that's all because these areas were built and there's no affordable housing built behind them. And all of a sudden, your average property is unaffordable for the average man. And so that's where we're kind of headed right now. It was good, 2-3 years ago. Interest rates were low. There was a lot of new builds, a lot of starts with apartments, but still the average house being built wasn't $150,000, $200,000 house that somebody could afford. It was a $400,000 to $700,000 house that was more of that mini mansion. So that is a passion project, and you have your hands full if you're going to try to help solve that one.
Well, here, let me just blow your mind for a second. Do you know that affordable housing is actually a charitable activity, that you could run it as an exempt organization? You can run it as a 501c3. We have folks that get into residential assisted living, transitional housing. You almost have to be a 501c3 when you're doing recovery housing, but you can still own the real estate in a for-profit, but receive state monies and grants as the nonprofit, and then pay the rents out to the for-profit. So you can actually basically be renting from yourself. People don't realize this, but I could literally write off 100% of my money if I want to invest it into affordable housing if I set it up right.
Wow. And so tell us,
nobody knows about it.
Toby, is that the setup? You said, if you left me hanging there, you said,
Here, let me explain it. So I have two great clients of mine, Frank and Sherry, and their daughter was affected by substance abuse. And if you know how some of these halfway houses are, I don't know another way to put it, but some of the housing, you can't even have ibuprofen. Right? You can't have any sort of drugs at all. And if you have other issues, mental issues, psychological issues, whatever, physical issues, then it's a no-go. So they looked for a different solution, especially for people that were incarcerated. So they went specifically for women who are nonviolent offenders who are in jail, typically because they were with somebody who was a drug dealer or involved in that world, and they got taken down with it. They don't need to be in a jail where we're paying as taxpayers, $70,000, $80,000 a year. So they went to the state of Washington. This is exactly how they structured it. We set up a nonprofit to advocate for recovery housing. Because of that, they were able to get audience with municipalities and state organizations, including the Department of Corrections. And drug court basically said, we need beds. So how about we give you $800 a month per bed, and we need 2 people per room. This is the size they gave the requirements. And they were able to get contracts where I think they have 5 houses right now under contract with a bunch more online, where the state is basically saying, hey, we're going to give you, let's say it's 5-bedroom house, 10 beds, $8,000 a month, whether they're used or not, for transitional housing. And it's so much cheaper to go that route. That's for housing purposes. That's maybe, $10,000 a year per inmate. And all they are is they're required to work out of that house. They can't party, they can't have guests, they can't have alcohol, they can't have drugs. It's easy for the state to monitor. It's great for the community, actually, because people actually embrace it and they say, hey, we're actually assisting now. We're not just locking people away. But the beautiful part was they could own the houses in their for-profit realm. So you can just own it. Typically, you're going to put a house in an LLC, right? Sure. You're probably going to have a holding LLC in a jurisdiction like Wyoming where nobody can take it from you. A topic for another day. Sure. But you're going to have the for-profit. Then it's renting to the nonprofit. The nonprofit's receiving the grant monies and paying the money. So basically, you could run it either entirely as a nonprofit, or you can do a combo. And these things work fantastic. And you still get you can still do your depreciation, you can still do your cost seg and accelerate your depreciation. And you just have to choose whether you're going to have the money flow directly into the for-profit realm, or whether you're going to keep a bunch of it in the nonprofit realm, or how you're going to set it up. You really have a lot of flexibility there. But that's just one example.
Perfect example. So even in that 506, 501c3 not-for-profit, you still take a salary out of there. There's just no profit distribution. So
They are
is the profit, or you set it up in such a way that that's the way you take money out of it, and you have a salary out of there, and then any of the rents that need to flow back to the for-profit real estate covers whatever your mortgage is. And so then your nonprofits stay in that to buy the next piece of real estate or to set up the next entity. And you just take out what you need for your personal living, pay off the real estate, pay down the real estate, et cetera, et cetera. So it seems like a genius type of idea. What about, Toby, for somebody that says, ooh, like, I don't know if I want to focus on like people that were incarcerated. Maybe some people don't have the stomach for that.
Oh,
is there another example?
Yeah, there's residential assisted living. There's transitional housing for, especially for young people, or there's housing for ill people that are unable to work, they're handicapped or whatnot. But there's tons of different programs. Here's the deal though, Josh, is you don't have to run the nonprofit. There are groups, like as a landlord, I have entire apartment complexes that I rent to organizations because they need housing for their people. And they're receiving public assistance. So again, you have to look at it. There's the operator side, and then there's the real estate ownership side. So in residential assisted living, for example, when you're working with the elderly and you're saying, hey, we need housing that's not nursing home, they want to live in regular houses, but you might have 5 people living together, right? There's the operator, the person that might do, hey, maybe they make meals, maybe they clean it, maybe they do laundry and things like that. And then there's the landlord, and you could be one or both, or you could just be an investor and just be a lender. And once you understand that this whole world exists, it's pretty interesting. I choose to, I am not an operator, but I rent to operators, and because I understand what they're doing, I can go out and shopping for them. So when somebody once Hosanna House in Winston-Salem, and they may say, hey, I have a need for eight people if you can get it. Here's the amount of the funds that are available. Can you find me something? And now you're going shopping to fill that need. And these are long-term leases. Usually they're 2 to 5 year leases. So it's just a different avenue. And you could just be the operator too. You don't have to be wealthy. If you have a heart for this thing, you could go put these things together. Because I'll give you an example. I have a client, Michelle, who's also up in Washington State. She gets a grant of $75,000 a year per home, plus she gets the rent. She has other people going out and buying the houses and providing them to her, renting them to her nonprofit.
So those buyers know that she is going to be a super reliable payer of the rent, if you will, because she's the operator and getting the money from the state, the government, et cetera, et cetera.
She's doing it with her kids. She's like, hey, kids, go out and start buying your houses. So her children, who are now getting their adult age, are starting to go out and buy houses. And it's like, how do you find cash flow properties in Seattle or in that area, right? This is how you do it, because you're not going to get it on a regular rental. You're going to get it by being a little bit creative and going in and solving some of these issues. Now, I'm just giving you one. There's tons of different things. You can do shared housing. There's a great company called Pad Split that does that. It increases your net by about 200%. In my experience, we back tested, and I have one client's with over 1,000 units. So I can just look at him and say, how much did you increase? And he was like, oh, this is my portfolio before, this is my portfolio after. But you can see it's right around, on average, 200%. But again, you're just going in and solving a niche. Instead of saying, hey, I'm just going to rent the house lock, stock, and barrel all together, maybe you're breaking it into rooms and renting 4 or 5 rooms out. And you're just looking at that's an easy tech solution. They're a great company where they're handling all the payments and everything else. And you're just getting a little more out of your property, which ordinarily you might walk away from something saying, hey, you know what, the cap rate's just not good enough on the regular rents, but this might give you another shot to go back in and still monetize something that you might have walked away from.
Yeah, I love it. I was going to ask you about the market, but I'm actually save that to the end, because we're already on to this discussion around different types of income, right? And as a legal and business and tax advisor, we were talking before the show about different types of income. And I don't know that every entrepreneur, every investor really understands each type of income that they can make, and then how that's taxed, and then also how to slash the tax and shelter the tax legally. But we've already kind of jumped into it, right? You have the operator income, you have the real estate income. There's different ways to shelter that through cost seg, which you already mentioned, accelerated depreciation, bonus depreciation, which you mentioned. So instead of going down all these different bunny trails, why don't we kind of bring this back to center, Toby, and go down one bunny trail at a time? And let's talk about a specific type of income that you see with your client, and how is the best way to not only make the income, but then to shelter it, slash it, and save it from tax. There's a lots of different ways to make passive income. I think maybe people are responsible for one or two. Like, I have a preferred return as a limited partner, or I make a loan and I get interest income. That's two different forms, but there's a lot of different things that you've done for clients. So why don't you just start with your favorite, and then we'll go on to 2, 3, 4, 5 from there.
Yeah, I mean, here, let me give you the easy view of income. This is your 30-second MBA, right? If you understand this, you're going to be way ahead of everybody else. There's really 3 types of income. And we sometimes break it down into 2 types of income. We usually say active or passive, but that's not right. There's something called portfolio income that sits in between them. Active income is like, when I was 16, I worked for McDonald's. You're making $4 an hour back then, and you work 40 hours a week. You think you're going to get $160, but you don't, because your federal income gets pulled out. But you also have this thing called old age disability and survivors and Medicare, also known as Social Security, also known as the self-employment tax, that's getting pulled out, and you end up getting, punched by this thing. And that's the way I want you to think of it. The tax code is literally going up and just popping you in the forehead and saying, by the way, I'm going to assess a bigger tax on you that I'm not going to do to everybody else, because active income is the only type of income that gets hit with the self-employment tax or the Social Security. They just go pop. So pretend you're in Catholic school and you're goofing off, and then a nun comes up and hits you with the ruler, right? That's what.
How did you know that actually happened to me when I was in third grade?
Hey, I could see fellow trauma babies, right?
Yeah, sure.
Mine would throw erasers. They would just, and they had really good aim, but it saw you in the back of the room moving your lips. They had hard, they had good arms, those nuns, but they would definitely correct your behavior. And the tax code has that as a correction, right? Yeah, believe it or not, when you look at the total collections of tax revenue, some years the employment tax, that Social Security, is more than the rest of all the individual income taxes. It's the surprise tax that nobody talks about. It's the biggest. It's right there as far as income tax, and the employment taxes are side by side. You can opt out of that. Like, you could literally say, I don't want to make any more active income. I'm simply going to go into portfolio and passive income. Portfolio income, you already mentioned one of it: interest, royalties, capital gains are technically portfolio income. None of these are subject to employment taxes unless you're the creator of the intellectual property, like you write the book or you write the code that gets you a royalty. But otherwise, because now you're working, you're back up into the active. If you're just an investor, you're going to be in this realm where there are no Social Security taxes. And that's point number 1. There's 2 buckets that we collect the most revenue for out of this country, and you can opt out of one of them. And the way you do that is get out of the active realm. If you're in the active realm, then I would encourage you, like you're a doctor, you're a lawyer, you're somebody who's making a lot of money. There are ways to reduce it, but it's a very long topic. The easy ones are retirement accounts, deferring it. You can defer. I have clients deferring $700,000, $800,000 a year going into a defined benefit plan for companies they own. You have your regular 401ks. You have charitable giving. Like, if anybody ever tells you there's nothing you could do, they're just not being creative enough, because I could literally write off 60% of your income, which is going to be about 70, 80% of your taxes, simply by transferring it into an exempt entity. And anybody can do that. So but that's the active realm. The passive realm really comes down to, there's only 2 types of passive income, and that's rents and businesses that you do not materially participate in. Everything else somebody tells you, like, oh, this type of income, your capital gains is passive. No, it's not. I mean, technically it can be. If you exit a syndication, it could actually be passive capital gains. And if you have passive losses from something else, you can actually offset it, which nobody understands, which if you understand just that one little piece, if you're into syndications, all of a sudden you're saving yourself massive amount of taxes because you can tell your accountant, hey, stop that. It maintains its character. If it's passive to me while I'm an investor, when I exit it, it's passive income. And passive income can only be offset by, or excuse me, passive losses can only be used against passive income. Right. So if we can recharacterize some of our income as passive, and we have passive losses, like you do a cost seg on a property, or you're in a syndication is kicking down losses, yeah, I could save some money. I could save some serious money if I understand that little nuance. But for investors, this is where it really gets exciting. When you have passive losses, like off of real estate, which is really easy to create passive losses. Every type of real estate you just mentioned, especially like manufactured housing, holy cow, we're writing off some of those. In some situations, it's 80% in the first year, right? It's just a ton of the value of that improvement that you're able to write off. And if you understand, hey, I could go looking for investments that create passive income. Like, hey, your uncle comes up and says, I want to do a pizza shop. Maybe I want to be a silent owner in the pizza shop. Maybe I don't want to be actively participating. Why not? Because now I have passive income from the pizza shop that I can use my passive losses from my real estate, so I pay no tax.
Right.
And I could be receiving a nice cash flow that's tax-free. And that's ultimately our favorite type of income, is the type of income that we don't pay tax on.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Yeah. And so what I've heard some people suggest, I had a guy on the show just maybe a month ago, and he mentioned, hey, if you're a W-2, you have a big income, and you're not a real estate professional, there's the rules around becoming a real estate professional. One of the suggestions he made was, buying a property for the specific purpose of making it an Airbnb that would require and would check the box for the definition of you're into it for a certain amount of time. You're the majority operator. You have to be in it more than anybody else. And so I just would love to hear your take on that idea, is that if you are a W-2 earner, you've got some passive income coming in, and you want to create some losses, maybe it's the reverse. Maybe you have losses coming in from a syndication because that syndication did a cost seg, but you can't use it because you have no active income against that. He was suggesting, hey, let's go buy some Airbnbs, let's go buy some rentals, turn them into Airbnb, do a little bit more management, become a real estate professional, and then you could take your losses against that active Airbnb income. That was one of the strategies that I was proposed. I don't personally do that, so just interested to hear your take on it.
I can break it down for you. So there's a lot of different, so there's two things. If I am an investor, then my passive losses, my losses are passive unless under 469C7, which is the code provision, I qualify as a real estate professional, which means if you're married, one spouse has to be primarily spending their time in a real estate profession. It could be development, construction, real estate agent, whatever. They're 750 hours and more than 50% of their time. And then you have to materially participate on your rental real estate. And now the losses are treated as non-passive. So there's that side. Number two is Airbnbs, if it's 7 days or less, is not a rental activity. It's even though you say I'm renting it, it is not. It's actually goes into the active role. So remember we have our active income. Now it's just trade or business income. And the only question is, are you materially participating? Because if it's trade or business income, then it's either passive. Remember I said I invested in my uncle's pizza shop, but I didn't participate. So I have passive income. Well, if I have Airbnb, I'm a pizza shop. If 7 days or less, it is a pizza shop. Now, the only question is, am I materially participating? Because if I am, then the loss is active ordinary loss.
Right.
So it's not real estate. You just have to divorce yourself from the idea that it's rental real estate. It's not. It's a pizza shop. And my Airbnb becomes something that I can immediately write off a big chunk of the personal property, which, if you know, that's what cost seg is. It's breaking a piece of property. I have a structure. How much of it is carpeting? That's 5-year property. How much of it is appliances? 5-year property. How much of it is cabinets? Might be 7-year property. How much of it is land improvement? You know, a driveway and a deck and some fencing. That's 15-year property. And then accelerating that. And so you get this big tax deduction. And then what do I do with it? So a lot of people, especially in syndications, they do that cost seg and they end up with this big passive loss. And then your only option is to become a real estate professional. But when you're sitting there doing the Airbnb, you could choose in first year, hey, you know what? I'm going to make it an Airbnb. I'm going to make it a pizza shop. I'm going to write off all of the personal property in that first year. In 2023, it's limited to 80%, but I'm going to write off this huge chunk of income and I'm going to materially participate. And there's 7 tests for material participation. The easiest one is, hey, if you run the Airbnb yourself and nobody else provides any substantial activities, you're good. Otherwise, then you get into the 100-hour or the 500-hour test. But if you do that, it's ordinary active loss. It's going to wipe out, it can wipe out your W-2 income. And I've had clients do this. I've had doctor clients that they have one spouse whose job is to go out and find the Airbnb, run it for the year. Once the year's over,
Multiple spouses. The way you said that, it was like they have one spouse out of their 4, and they select that one. I'm just joking. It just came across in my weird brain that way. Sorry.
Your spouse says it. Hey, I don't judge.
No judgment.
But that's what they're doing. They're literally saying, because I'll give you a real life example. So I had a couple. The wife was a surgeon, husband was a real estate investor, and I introduced him to the concept. I said, wow, you know, chances are the husband's going to qualify as a real estate professional. Then all we need to do is look for, we have an tax appetite now for taking a huge deduction, because she was making close to $1 million a year as a surgeon. Every dollar that they can write off in accelerate and depreciation is 37 cents. They were in Washington State, so they didn't have a state income tax, but it was quite a bit of money. The first year that we did a cost seg and qualified him as a real estate professional, their tax savings was $183,000. Yeah. So that's just more powder for them to go out and buy more properties, which then they cost seg and continue. It becomes a cycle. And that's why you see folks, when they really understand it, the old adage was, if you're paying taxes, it's because you don't own enough real estate. That's why that is true. And then all you have to do to never pay tax on this stuff is die. And your basis steps up. You pay, your heirs will pay 0 tax if they sold the whole thing, or they can redepreciate it. So the tax code is literally saying, hey, Josh, I'm going to let you buy something. You get to write it off. And then when you die, your kids are going to write it off again, but at the new value. And then when they die, their kids are going to write it off. Like it's the tax code is telling us what to do, which is
the tax code based on this discussion, which is fantastic. Really, really fun discussion is, you know, that active income, that W-2 income is the worst type, right? And so you get punched in the face.
Yep.
And they're also telling us, right, buy the real estate, defer. They're doing
this. You're great. You're a great kid.
Yeah.
That's what they're doing. It's like the nun comes up and says, Josh, you're such an angel. And you're like, you know, you're doing that. So happy.
Yeah, I love it. And if you are going to sell something in the interim, because you just feel like it's, you know, run its useful life, and you want to, then you do the 1031 exchange, and then you defer it into another property, and then you defer, die, and then get the step up in basis for your kids. Phenomenal discussion. Toby, I love this stuff. Listen, as we kind of wrap up here, obviously you being an investor in over 300 properties and running your firm, you've been on your own kind of entrepreneurial journey, not just as an advisor and an investor, but as an entrepreneur. building a company and then having your expenses and your staff and dealing with your team and growing that business. What do you think are maybe 2 or 3 traits that you have to be an elite entrepreneur? What are 2 or 3 things maybe that you've done or that other investors or other entrepreneurs that you've noticed? What are some traits that you think you have to go from not just becoming an entrepreneur, but to becoming an elite entrepreneur and really operating at a super high level? If there's a couple of things that jump out to you, what do you think those are?
Yeah, I would say it's your belief system. So it's always the checkup from the neck up. It's not, there's an old adage that it's not my drinking that's got me stinking. It's my stinking thinking that's got me drinking. It's this, I got to fix this first. Otherwise everything else is for naught, because you'll be swayed all over the place. So everybody's going to tell you that you suck. They're going to tell you that you're going to fail. They're going to tell you that you're going to lose your money. You're going to go out there. And if you want to be an elite entrepreneur, you're taking some risks. So you got to make sure that your mind is right. And your mind has to be, and I see this over and over again. There's actually really good studies. It's called locus of control. It's the belief that you can control your outcomes and that you can do it, basically. So, it's like in your ear, you should be whispering, I can do it. I can do it. I can do it. Because everybody's going to be telling you all the stuff that's going to screw you up. Your family is going to not understand you. I'm buying real estate and my dad's like, oh, that's risky. I still remember those conversations. I was like, okay. All the rich folks are doing it, right? Yeah. All the people I know that are independent, that don't have to work, they're doing it, right? So you're going to have that belief where you're able to take those torpedoes. And also, you're going to have to work your ass off. There are no free lunches. I just believe that you're going to have to really put your head down and work hard and believe that you can control that outcome, which is going to allow you to work that much harder. And you're going to transition from the active world to the passive world. That's the ultimate goal is, hey, they're hitting us, and you're going to get hit as you develop as an entrepreneur. You're going to make active income quite often. And the trick is to go from that entrepreneur over to the passive investor. And that passive investor is where you can kind of sit back. And then I'll give you the last trait. And this is one from Warren Buffett. I'm going to paraphrase it. You take your right hand and you stick it underneath your right butt cheek, and you take your left hand and sit it underneath your left butt cheek, and don't do stuff. Plant seeds, let them grow. If you're going to be an investor, you're in it forever. I wrote a book called Infinity Investing. The whole idea of it is your holding period is forever. Like, you're creating something that you're not going to sell. We're not in it for the short term. You're buying something because it's going to be around in 200 years. And it narrows your investments down quite a bit. Now, if you're doing syndications, all right, I get it. The syndicator is saying, hey, we're going to take this apartment building, we're going to buy it, we're going to fix it up, we're going to increase its net operating income, which was naturally going to increase its value. We're going to sell it. We're going to take that money. Okay, I get that, but you need to be planting those investment seeds that are paying you. And, and part of it is just being patient and allowing those to come to fruition. Because I never would have thought that we'd be sitting on the real estate portfolio that we're sitting on. The only reason we are is because we said, hey, let's buy one a year. One property a year, we'll add it to our portfolio. You get there. That was easy. Let's do 2. Let's do 3. Let's do 1 a month, and then eventually 20 years later, you're sitting on this big portfolio and you're like, that was easy.
Yeah. It was a ton of work over 20 years. But look, no, I love that. Like, plant the seeds and let them grow. In particularly because so many people are using real estate for short-term income, and they think they're a real estate investor, but all they've really done is become super transactional. And all it really does is create short-term active income. Then all of a sudden you're getting slammed with Social Security tax, which is at or equal to or above your federal income tax. And they did it all wrong. And instead of being patient, maybe taking not as many chips off the table at the beginning and holding those assets for the next 10 or 20 years, that's the way that ultimately you get rich. It's not get rich overnight. It's get rich, period, during your lifetime, so that you can leave behind those dollars and those assets for the next generation and beyond that, and also pay very little tax along the way. If you're not, I would tell our listeners, like, if you're not actively asking yourself and your advisors and your accountants, like, how do I pay no tax this year? That should be an active question that you're asking every year. Is, how do I just pay no tax this year? It should literally be a goal. It's not like you don't get a medal for paying the government money. Like, nobody's going to give you a medal, especially when the tax code's written for landowners. right? It's all the politicians, all the elites, they all own land, they all own businesses. That's what it was written for. So if you're like, well, yeah, I made a big income, I paid a huge tax, you're doing it all wrong. You need a guy like Toby to help you out.
They all own foundations too. They all own charities. You'll never see a rich guy without having some sort of philanthropic endeavor sitting by. It's like when Elon was selling off Tesla, we knew what he was doing. We knew there was going to be a big charitable component, that he was giving away shares, because you can write off. You don't have to sell a stock and get a deduction when you give it. You can give the stock to charity and you write off its fair market value as long as you held it over a year. So he has all these shares that he's got like no basis in, and he's giving it away. And everybody's saying, wow, that was a big charitable deduction. Yeah, he was just offsetting the sale from the shares of Tesla. Yeah. So it's like, he's smart. That's what they all do. And so why fight it? Like, the tax code is written for all of us. There's rules. It's kind of like if you were playing football and, you had 4 downs, but you decided you only had 3. So you always punted on 3rd down. It's like you self-imposed that rule. The rule says you got 4 downs.
Yeah.
You're acting crazy, right? And that's what we do. It's like the rules are there. Choose to use them to your advantage and do that.
Awesome stuff, Toby. Listen, Andersen Legal Business and Tax Advisors, that's his company that he founded. It's got all these investments, helps lots and lots of entrepreneurs, just like all of you, our listeners. So Toby, I'm sure a lot of our listeners will want to engage with you and figure out how they can not only be a better entrepreneur and a better investor, but then also slash the taxes along the way. How can they get a hold of you?
Easiest way actually is this. Just type my name into the internet and go to my YouTube channel. I could give you links. I could do all this fun stuff, but realistically, just type in Toby Mathis, go to my YouTube channel, put this stuff out, about 3 videos a week, where we're always trying to help. Like, we literally are just a big community of investors. We're just trying to help each other out so that we can all do better. And here's my belief. Ready? Simple belief. You're better with your money than the government's with your money. So keep it in your pocket and do good things with it.
Fantastic stuff, Toby. Listen, thanks so much for joining us today on Accelerated Investor.
Thanks.
Well, there you go, guys. There you have it. Hope you enjoyed that discussion. I enjoyed it so much that I'm actually going to invite Toby to speak to my mastermind group, my Forever Passive Income Maverick Mastermind members. Again, very intermediate to advanced group of investors who are partnering, doing deals, both multifamily, self-storage, residential assisted living, and on and on and on. So I'm going to have Toby come and specifically help that group. If you're interested in becoming a member of that group, we are taking applications. It's by application only. That mastermind and partnering group you can find at joshcantwellcoaching.com. Also, if you're not quite ready yet for the mastermind, but you want to learn more about commercial multifamily investing and apartment syndications, go grab a ticket for our next live event at foreverpassiveincome.com. We'll see you next time. Take care. Don't forget to like, subscribe, rate, and review. See you next time. Take care.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.